If you look at the heavy equipment rental industry right now, it is honestly pretty sleepy.
Yeah, very sleepy.
I mean, we are talking about a highly mature, heavily consolidated space. It generally just tracks along with standard macroeconomic growth.
Right, maybe expanding at, 2 or 3% a year on average?
Exactly, 2 or 3%. So when a company based out of Columbia, Missouri called EquipmentShare announces they just grew their rental revenue by 37% in a single quarter.
Which is just a massive number.
It's wild. And they did it without blowing up their balance sheet or taking on, reckless amounts of debt. You have to stop and ask a fundamental question.
Right.
Like, did they just find some temporary loophole in the local economy? Or did they fundamentally break the established rules of the construction industry?
It really forces you to completely reevaluate the baseline assumptions of the entire sector.
Yeah.
Because when you see a heavy machinery company putting up numbers that rival like an early stage Silicon Valley software firm, it implies a structural advantage that the legacy players simply do not possess.
And that is exactly what we are going to unpack today. Welcome to Talk Tickers and this specific deep dive. Our mission today is to tear into the Q1 2026 earnings call from equipmentshare.com. That's ticker symbol EQTPT.
Right.
And for you listening, whether you are managing a portfolio, running a business, or you're just fascinated by how the physical world actually gets built, this is a literal masterclass in applying digital leverage to analog real-world problems.
It really is. And, the broader context here makes those numbers even more jarring.
How so?
Well, if you look at the macroeconomic data over the last, 80 years, construction productivity, which is literally the measure of output per worker, has been functionally stagnant since the 1940s.
Wow. Since the 40s.
Yeah. I mean, manufacturing experienced this massive revolution with robotics and lean supply chains.
Right.
Agriculture saw the introduction of, GPS-guided autonomous combines, but the commercial construction site, it largely just remains stuck in an analog era.
Clipboards and walkie-talkies.
Yeah. Exactly. Clipboards, whiteboards, manual phone calls, and constantly lost keys.
Which sets the stage perfectly for what EquipmentShare is actually trying to pull off here. Because when you read through this transcript, they are not talking like a traditional equipment lessor at all.
Not even close.
They're positioning themselves as the operating system for the physical job site. But before we get to the technology, let's anchor ourselves in the hard data.
Always a good idea. Let's look at the numbers.
Yeah, I want to lay out the top line results from Q1 2026 because the raw scale of this growth is it's difficult to comprehend in a capital-intensive industry.
Yeah, it really is.
So for the quarter, total revenue hit $989 million. That is a 38% increase year over year.
Which, just to jump in, puts them on a nearly $4 billion annual run rate.
Yeah.
Just to contextualize the sheer size of the operation we're talking about today.
Precisely, $4 billion. And drilling down into that, the core rental segment revenue was $764 million, up that staggering 37% we mentioned at the top of the show.
Right.
Adjusted core EBITDA came in at $399 million, which is a 39% jump year over year. And they also noted a trailing 12-month adjusted core EBITDA of $1.78 billion.
And, those growth rates are incredibly rare for a company dealing in physical assets.
Right, because of the overhead.
Exactly. You expect a SaaS company to grow at 40% because their marginal cost to distribute one more software license is essentially zero.
Just server space.
Exactly. But EquipmentShare is distributing physical excavators, massive boom lifts, mobile generators. Every single dollar of revenue requires moving thousands of pounds of steel across the country.
Which actually brings me to a metric buried a bit deeper in the transcript that frankly made me do a double take.
Oh, the mature margins.
Yes. Management cites their quote-unquote mature rental location margins. They reported a 55% margin for sites that have been operating for more than 24 months.
It's a huge number.
I mean, I have to play devil's advocate here because 55% margins in heavy industrial sounds almost suspiciously high.
It does. It sounds like a typo.
Right. Usually, if you're running a 55% margin in a localized market, a legacy giant like, United Rentals or Sunbelt is going to notice, drop their daily rental rates by 20%, and just try to price you out of town entirely. So how are they achieving and defending that kind of margin?
So to understand the defense there, we first have to look at the mechanics of how a physical rental yard actually matures.
Okay.
In this industry, when you open a new market, it's referred to as a greenfield site. And year one of a greenfield site is just an exercise in massive capital output with very, very little immediate return.
Because you're setting everything up from scratch.
Exactly. You are leasing commercial real estate, you're hiring local sales representatives, employing certified mechanics, and most importantly, you are shipping millions of dollars of brand new, highly expensive yellow iron right onto the lot.
So your fixed overhead is at its absolute peak from day one, but I'm guessing your fleet utilization is terrible because nobody in town even knows who you are yet.
That is exactly the problem. The machinery is just sitting idle on the lot, depreciating, while you pay full price for the staff and the real estate.
Ouch.
Yeah. But the transcript details this very specific inflection point at the 24-month mark.
Right, the 2-year mark.
By month 24, those local contractor relationships are deeply cemented. The local market absorbs the fleet, pushing utilization rates up to highly efficient levels.
Got it.
And because the heavy fixed costs of the real estate and the baseline staff are already covered by that initial revenue base, the unit economics just completely flip. Every incremental dollar of rental revenue that comes in after that break-even point flows almost entirely to the bottom line.
So a mature location is basically just a yard that has survived that initial capital burn and reached escape velocity in its local market.
That is the perfect way to frame it. Yes. Once they cross that 2-year threshold, the local yard basically becomes a compounding cash machine.
Wow.
And that 55% margin tells us that for every dollar of revenue a mature site generates, 55 cents is profit before interest, taxes, and corporate overhead.
That's incredible.
It demonstrates an incredibly sticky economic engine that essentially allows them to self-fund their own future growth.
But okay, self-funding only goes so far when you are growing top-line revenue at 38%.
True.
My immediate instinct when I see heavy industrial growth at this velocity is to check the debt.
Naturally.
Because you can always buy market share if you are willing to swipe the corporate credit card and lever up the balance sheet to, dangerous levels.
Right. We see that all the time.
We do. But the financial engineering in this quarter shows the exact opposite. They reported their net leverage actually decreased to 2.8 times, down from 3.2 times a year ago.
And honestly, that deleveraging is the single most impressive financial achievement in the entire earnings call.
Really? More than the revenue growth?
I think so, yeah. In the broader equipment rental space, operating at a leverage ratio under 3.0 times EBITDA is considered a highly conservative, almost defensive posture.
Interesting. And Dave Marquardt, the CFO, he mentioned on the call that the primary driver for this drop in leverage was using the proceeds from their recent IPO to pay down outstanding borrowings.
Right. They had that cash injection.
But even with an IPO cash injection, sustaining 37% growth while keeping leverage under 3.0, that requires an immense amount of organic cash flow.
It does. And that cash flow is the direct result of those 55% mature margins we just discussed.
It ties right back.
It does.
Yeah.
Those established yards are throwing off so much free cash that EquipmentShare can deploy new greenfield sites without taking on massive tranches of new debt. They have effectively built this internal flywheel where the mature assets finance the expansion of the new assets.
Okay, so the financial picture is incredibly robust, but we still haven't answered the core mystery.
Which is?
Well, the equipment rental industry is an $84 billion market globally. It is entrenched, it is highly fragmented, but it's dominated at the top by massive publicly traded incumbents with bottomless pockets. EquipmentShare can't just show up with a shiny new fleet and organically steal 37% more market share in 12 months based on, good customer service alone. They need a structural unfair advantage.
Which brings us to the technological moat. Management makes it abundantly clear throughout the entire call that they do not view themselves strictly as an equipment rental company.
Oh.
Yeah, they view themselves as a technology company that just happens to monetize through physical assets. The foundation of this entire growth narrative is their proprietary technology platform, which they call T3.
The way Willy Schlex, the president, describes T3 in the transcript is fascinating. He specifically uses the term vertically integrated technology stack.
Right.
Now, that is a phrase we usually hear tossed around in Silicon Valley sauce pitches, not, heavy machinery earnings calls.
Exactly.
I really want to spend some real time exploring the mechanics of this because it seems to be the absolute linchpin of their valuation. So what does vertical integration actually look like when you apply it to a fleet of bulldozers?
Well, it requires controlling every single layer of the data ecosystem, starting at the physical root. EquipmentShare does not just buy off-the-shelf tracking software.
Like standard GPS.
Right. They don't do that. They design, manufacture, and install their own proprietary hardware directly into the machinery. They are building their own sensors, telemetry units, digital keypads, and physically hardwiring them into the engines, the hydraulic lines, and the ignition systems of the fleet.
Wait. I need to pause on the mechanics of that. It is one thing to integrate software into a brand new 2026 model excavator that comes pre-built with modern digital interfaces.
Sure.
But rental fleets are incredibly mixed. How do you integrate a cloud-based technology stack into like a 15-year-old analog backhoe? You can't just plug a USB drive into the dashboard.
And that is exactly the genius of their hardware engineering team. They are essentially retrofitting an intelligent nervous system onto analog machinery.
Really?
They spliced their proprietary telematics units directly into the CAN bus, which is the internal communication network of the machines, regardless of the original manufacturer.
Okay, wow.
Yeah, they just completely bypassed the OEM's closed ecosystems. So whether it's a Caterpillar, a John Deere, or a Komatsu, the T3 hardware overrides that fragmentation and standardizes all the data output.
That is wild. And that hardware layer feeds directly into the second layer, which is the data itself.
Oh, right.
Because by owning the physical sensor, they aren't just getting a basic GPS ping every hour. They are capturing live, high-fidelity operating signals.
Millions of data points a day. They monitor engine fault codes, hydraulic pressure variances, exact fuel consumption, idle time, and even operator behavior.
Everything.
Everything. In the tech industry, this is known as creating a digital twin. It's a perfect, real-time virtual replica of the physical job site. T3 knows exactly what every machine is doing at every second across thousands of locations.
And then the third layer is the actual software interface, right? The application layer that the contractor actually uses to interact with all this data.
Yes.
Because reading the transcript, the way contractors used to manage this was horrifying.
It was a mess.
They would have like one portal for John Deere equipment, a totally separate login for their United Rentals fleet, an ancient ERP system for billing, and then a literal physical whiteboard in a trailer somewhere to track their human workers.
Yeah, that was the standard.
And EquipmentShare is taking that fragmented nightmare and collapsing it into a single multi-tenant environment.
A single pane of glass for the entire job site.
It makes me think of an analogy. T3 feels less like a standalone app you download to track a truck and much more like the iOS of the job site.
Oh, that's a good comparison.
Right. If you look at Apple, the reason the iPhone is so deeply sticky and seamless is because Apple designs their own silicon chips, they write the core operating system, and they control the user interface.
They own the whole stack.
Exactly. Because they own the entire vertical stack, everything integrates flawlessly. And it sounds like EquipmentShare is doing the exact same thing for construction. They build the hardware sensor, they control the data stream, and they write the software interface. It is one native ecosystem.
The iOS analogy is incredibly apt, especially when you examine how that native ecosystem solves massive, real-world friction points.
Let's get into some examples.
Yeah, the best way to understand the actual economic value of T3 is to look at the concrete example that Javek Schloss, the CEO, spent time discussing during the Q&A portion of the call.
Oh, you mean access control?
Yes, access control.
That segment of the transcript is where the mental model really clicked for me. So walk us through a scenario where this technology becomes indispensable for a contractor.
Picture a modern mega project. Let's say it's a massive multi-billion-dollar semiconductor fabrication plant being built in Texas or Arizona.
Okay, huge scale.
The scale of these sites is difficult to comprehend. You have a footprint the size of a small town. You have dozens of different totally independent subcontracting companies operating simultaneously. You have thousands of human workers on site and thousands of pieces of heavy equipment just scattered everywhere.
It's just organized chaos on the best of days.
Exactly. And in a legacy environment, that chaos breeds massive inefficiency and risk. Imagine a worker walks up to a specialized aerial boom lift that costs, say, $150,000.
Okay.
In the old analog world, how does the site manager actually know if that specific worker is properly trained and safety certified to operate that specific machine?
They probably don't.
Right. And furthermore, how do they know if that worker's specific subcontracting company is currently paying the rental contract for that piece of equipment?
They usually don't know that either, or they rely on these awful manual choke points, like foreman with a clipboard physically checking badges and cross-referencing paper logs.
Which takes forever.
Right. Or, what happens far more often on busy sites, the worker just uses a universal fleet key. which, by the way, are notoriously easy to buy online, hot wires the machine and just gets to work.
Which introduces terrifying liability.
Yeah.
I mean, if an uncertified worker flips a boom lift, the insurance nightmare alone can stall a project for weeks.
Oh, absolutely.
Not to mention the direct cost of unauthorized use, equipment hoarding, and outright theft. But with T3, because EquipmentShare built both the embedded hardware on the machine and the cloud software managing the site, the machine natively knows who is allowed to turn it on.
So T3 basically acts as an invisible bouncer for every piece of heavy iron on the site.
That is exactly what it is. T3 digitally answers a highly complex question in milliseconds. Can this specific human use this specific machine right now?
So how does the worker actually start it?
The worker walks up to the boom lift and either punches a unique pin in into the T3 keypad installed right on the dashboard, or they use their smartphone to scan in. The T3 cloud instantly cross-references that worker's identity, verifies their OSHA safety certifications are up to date, and checks if their employer has an active rental agreement for that asset.
And if everything checks out.
If all the lights are green, the ignition circuit physically unlocks and the machine starts. If they aren't authorized, the engine just remains dead.
We have to translate this into the economic value proposition for the customer, though, because, access control sounds incredibly cool from a technological standpoint, but general contractors operate on razor-thin margins.
Very thin.
They only adopt new technology if it demonstrably saves them money today. So how does this feature directly impact their bottom line?
The financial savings are immediate and massive. First, you completely eliminate the administrative overhead. There are no more radio calls to the front office trailer asking for permission to use a machine, which saves thousands of man-hours over the life of a project.
That adds up fast.
It does. Second, you eliminate theft. A stolen machine is entirely useless if the ignition is permanently locked by a cloud server. But the most profound economic impact, and the one the CEO specifically highlighted in the call, is the prevention of wasted rentals through shared custody.
Yeah. Break down the mechanics of how shared custody works on T3.
So on a legacy job site, let's say subcontractor A rents a generator for Monday and Tuesday.
Okay.
But they finish their task early, so that generator just sits idle on Wednesday. Meanwhile, subcontractor B suddenly needs a generator on Wednesday.
Mm-hmm.
In the old world, subcontractor B calls the rental company. The rental company dispatches a heavy-duty flatbed truck, drives a brand new generator clear across the city, drops it off, and charges them a full delivery fee and a rental rate.
All while an identical, perfectly functional generator is just sitting unused 50 feet away.
Exactly. It is wildly inefficient. The carbon footprint alone of trucking redundant machinery around a single city is absurd.
But T3's digital ledger fundamentally changes that dynamic.
It does. Because T3 understands the concept of caretakers, subcontractor A can pull out their smartphone on Tuesday afternoon and digitally release custody of that specific machine back into the site's available pool.
Oh, wow.
Yeah. And then subcontractor B can see on their app that the machine is physically on site and available. They digitally take custody, the billing automatically transfers in the T3 cloud, and subcontractor B can just walk over and instantly unlock the machine. EquipmentShare never has to send a truck.
That is a total paradigm shift. They are taking a chaotic physical environment and turning it into a hyper-efficient shared digital network.
Yes, they are.
And what becomes abundantly clear in this earnings call is that this specific technological advantage, this ability to orchestrate chaos, is exactly what is allowing EquipmentShare to capture the single largest secular tailwind in the global economy right now.
The mega projects.
Exactly. I'm talking about the rise of the mega project.
Yeah. We really have to zoom out and look at the macro environment here, because the construction market is undergoing a historic transformation. The explosive growth in construction right now is not being driven by local contractors building, suburban strip malls or single-family subdivisions.
Right.
The massive influx of capital is flowing into infrastructure mega projects. We're seeing a generational build-out of data centers, advanced semiconductor manufacturing, battery plants, and energy grid modernization.
This is the onshoring supercycle. It's the physical manifestation of bringing critical supply chains back domestic. And the transcript dedicates significant time to highlighting their exposure to data center construction specifically.
Yeah, the numbers there were insane.
The numbers they casually threw out regarding power consumption requirements were absolutely staggering. We need to do a quick deep dive into the physics of kilowatt rack densities, because it explains perfectly why traditional rental companies are structurally incapable of keeping up with this demand.
It is the defining bottleneck of the artificial intelligence boom. The CEO pointed out that just a decade ago, if you were building a standard enterprise data center, the server racks inside consumed roughly 8 to 12 kilowatts of power per rack.
Okay, 8 to 12.
That was the established industry standard, and the cooling and power infrastructure of the building was designed around that 12 kilowatt baseline.
But then generative AI, large language models, and advanced power-hungry chipsets like NVIDIA's Blackwell architecture arrived and completely destroyed that baseline.
Completely destroyed it. The transcript notes that the next generation of AI data centers currently breaking ground are being designed to support rack densities of 100 to 600 kilowatts.
Let me just pause to let the math settle on that for you listening. We are talking about a 50-fold increase in the sheer volume of raw electricity required to operate the exact same square footage of server space. A 50-fold increase.
And power creates heat. A 50-fold increase in electrical draw means an exponentially massive requirement for advanced thermal management and cooling solutions.
You can't just open a window.
No, you cannot. And you cannot simply plug a 600 kilowatt per rack facility into the local municipal power grid on day one. The local grid often doesn't even have the substation capacity built yet.
Right.
To even construct, test, and commission these facilities, contractors need massive, modular, mobile power generation. They need temporary microgrids. They need highly specialized industrial climate control just to keep the ambient temperature stable while they install the permanent chillers.
And this is where EquipmentShare's specific expertise shines. They highlighted in the call that their Advanced Solutions division, which is the specialized segment that handles complex power generation, fluid movement, and climate control, is currently the fastest growing part of their entire business.
They are perfectly positioned.
They are sitting at the absolute epicenter of the AI physical infrastructure build-out.
And you have to consider the risk profile of the customer building these sites. These mega projects are unbelievably complex. The timelines are brutally tight, often driven by race-to-market dynamics in the tech sector.
Time is money. Exactly. The execution risk for the general contractor is astronomical. If a critical mobile power generator goes down on a billion-dollar data center project, it isn't just an inconvenience. It can halt the commissioning of sensitive servers, costing hundreds of thousands of dollars an hour in delayed construction schedules and penalties.
So these mega customers aren't just looking for the cheapest daily rate on a generator. They are looking for a partner who can fundamentally guarantee uptime.
Yes.
Which brings us to my absolute favorite anecdote from the entire Q1 call. This is the real-world case study that takes all of this abstract technology and translates it into actual market share capture.
The top 50 customer.
Yes. The CEO discussed a customer they refer to as a top 50 ENR customer. Now, for those unfamiliar with the terminology, ENR stands for Engineering News Record. It is essentially the Fortune 500 list for the global construction industry. If you are a top 50 ENR firm, you are the apex predator of the construction world. You build the largest infrastructure on the planet.
And what was the specific dynamic with this ENR customer that they brought up? Well, this top 50 firm is currently managing one of the largest renewable power projects in the world. Initially, they awarded the equipment rental contract to a legacy traditional competitor.
Interesting.
Yeah, and the CEO frankly admitted that EquipmentShare's geographic footprint in that specific region wasn't quite dense enough at the time to fully support a project of that magnitude from day one.
Okay.
But earlier this year, that massive customer abruptly canceled the legacy contract and migrated 100% of their multi-million-dollar rental spend over to EquipmentShare.
Moving 100% of a mega project spend midstream is a monumental logistical headache for a contractor. They don't do that unless the pain of the status quo is unbearable. Did management elaborate on exactly what triggered the switch?
They did, and it is the ultimate validation of the T3 platform. The customer did not switch because EquipmentShare offered a cheaper price. In fact, they likely paid a premium. Yeah. The customer specifically cited T3's access control, the ability to manage thousands of disparate machines through a single dashboard, the depth of the service network, and, crucially, predictive maintenance.
Predictive maintenance. That is where the data layer of T3 moves from being an operational tool to a literal strategic weapon.
How so?
Because EquipmentShare's hardware is receiving thousands of live telemetry data points every second from the internal components of that generator, their software can essentially see the future.
See the future.
Yeah, the algorithms can detect the microscopic vibrations in a bearing or the subtle temperature spikes in a hydraulic fluid line that precede a catastrophic mechanical failure.
So it's the difference between reactive chaos and proactive engineering.
Exactly. Instead of the generator failing at 2 a.m., causing a massive power outage on the site, T3 flags the anomaly days in advance. The system automatically generates a service ticket, checks the local warehouse for inventory, and dispatches a certified technician to the site with the exact correct replacement part.
And the contractor barely even notices.
Right. The part is swapped out during a scheduled maintenance window, and the generator never actually breaks down.
So to that top 50 ENR customer, EquipmentShare is not an equipment rental company at all. They are a multi-million-dollar risk reduction engine.
Perfectly said.
And that specific capability provides EquipmentShare with immense structural pricing power. While the legacy competitors are trapped in this race to the bottom, fighting over who can offer the cheapest daily rate on a dumb piece of iron, EquipmentShare changes the conversation entirely.
They rewrite the rules.
They do. They can say to the contractor, look, our daily rate might be higher, but we will mathematically ensure that your billion-dollar project does not grind to a halt because someone lost a physical key or a blown gasket shuts down the power grid.
But, that massive technology moat creates a new problem.
What's that?
Capital requirement. If they are successfully displacing entrenched competitors on these massive capital-intensive mega projects, they need more machines, a lot more machines,
right?
Which explains why the financial guidance they issued for the remainder of 2026 is so incredibly aggressive.
Let's dig into that updated outlook. Because if you thought the Q1 numbers were hot, the management guidance suggests they're pressing their foot even harder on the accelerator.
They really are.
They raised their outlook across the board for the full year. Total revenue guidance was bumped up to a massive range of $5.15 billion to $5.58 billion.
Wow.
Yeah. The core engine of the business, the rental revenue growth, was revised upward to 29% at the midpoint, which is an increase from their prior guide of 27%. And adjusted core EBITDA was raised to a range of $1.88 billion to $2.0 billion.
And for a management team to raise their full-year guidance by 2 full percentage points after only the first quarter of the year is a massive signal of internal confidence.
Right, because usually they play it safe.
Historically, yes, industrial management teams prefer to keep some powder dry in Q1. They want a buffer in case the busy summer construction season softens or a macro shock hits. To confidently raise the guide this early in the fiscal year indicates that their visibility into the forward project pipeline is exceptionally clear, and their current order book is essentially overflowing.
And to capture that overflowing demand, they have to physically expand. They ended Q1 with 407 operational locations nationwide. They have now raised their year-end target to 431 full-service locations.
Okay.
But the long-term strategic target mentioned in the transcript is the real jaw-dropper here. They are officially planning to reach approximately 700 full-service rental locations by the year 2030.
700 locations means they're looking to nearly double their physical footprint in roughly 4 years. The level of capital expenditure, operational discipline, and sheer execution required to pull that off without destabilizing the company is immense.
Which actually brings us to a highly technical, slightly contentious moment during the Q&A portion of the earnings call that we really need to translate for our listeners.
Oh, the accounting question.
Yes. Because whenever a company is growing this fast and issuing this kind of aggressive guidance, retail investors have to be incredibly vigilant about how management is calculating their profitability.
Absolutely.
An analyst named Ken Newman from KeyBank asked a very pointed question regarding their adjusted core EBITDA guide, specifically concerning stock-based compensation, or SBC.
This is a critical nuance for anyone trying to accurately value the underlying cash flow of the business. Stock-based compensation is often the biggest red flag in modern corporate accounting.
It really is. It is often dilution masquerading as a non-cash adjustment.
Right.
Many tech companies will issue massive recurring stock grants to their employees and then add that expense back to their adjusted EBITDA to make their core operations look far more profitable than they actually are. It is a terrible practice because those stock grants eventually dilute the existing shareholders. It is a very real economic cost.
Completely agree.
So when the analyst noticed that EquipmentShare was suddenly excluding $17 million in non-cash stock-based compensation from their Q1 adjusted EBITDA calculation, the immediate suspicion is naturally, are they using an accounting gimmick to artificially inflate their raised guidance?
And that is a perfectly valid suspicion to have. However, the CFO, Dave Marquardt, provided a highly transparent and compelling defense for why this specific $17 million exclusion is mathematically and ethically justified.
Okay, let's hear it.
It all comes down to the unique structure of these specific stock awards. Marquardt explained that out of the $19 million in total stock-based compensation for the quarter, $17 million is tied exclusively to what the company defines as IPO Founder Awards.
Break down how these founder awards function differently than like standard employee stock options.
Well, these are performance-based stock units that were granted to the foundational team during the IPO process. The critical distinction is that these shares do not vest over a simple time horizon. They cannot be issued or sold unless the company's stock price hits a series of massive, predefined market capitalization hurdles.
And the final hurdle they mentioned is frankly staggering. The transcript notes that the final tranche of these founder awards only becomes issuable if Equipment Share achieves a $90 billion market capitalization.
Which is an absolute moonshot. A $90 billion valuation would require the company to multiply its current enterprise value several times over.
So then why are they taking a $17 million charge for it today if it requires a $90 billion valuation to ever actually pay out?
Because of the strict nature of generally accepted accounting principles, or GAAP. Standard accounting rules mandate that the company must estimate the theoretical fair value of this potential future payout based on complex probability models, and they have to amortize that estimated against their current earnings today, regardless of whether the shares ever actually vest.
Ah, I see. So GAAP requires them to take the hit on the income statement right now, even though no actual cash has left the building and no actual shares have been issued to dilute the investors.
Precisely. From a pure operational standpoint, that $17 million expense has zero impact on the actual cash-generating power of the rental fleet today. It is a mathematical phantom required by the SEC.
Wow.
By explicitly excluding this specific hurdle-based $17 million from their adjusted core EBITDA, management is actually providing investors with a much cleaner, more accurate picture of the real cash flow the yards are generating right now. It prevents the theoretical accounting of a $90 billion moonshot goal from distorting the reality of the Q1 operating results. So it's not a gimmick, it's an attempt at radical transparency.
That makes total sense, and I appreciate the deep dive into the accounting mechanics there. But analyzing the numbers brings us to the most fundamental question of the entire deep dive.
The big one.
The question every seasoned, battle-scarred investor asks when they see a company growing revenues at 38%, modeling 700 locations by 2030, and surfing a mega project wave. The question is, are they growing too fast?
It is the primary risk factor, without a doubt.
Right. Are they getting over their skis? Because construction is a cyclical industry. What happens if the macro environment suddenly fractures? If interest rates stay higher for longer, stalling capital availability, or if a severe recession hits and these mega projects get paused? Is Equipment Share going to be caught holding billions of dollars of idle, rapidly depreciating yellow iron while carrying the overhead of 431 physical locations?
To answer that, we have to stress test their risk management framework. And based on the mechanics outlined in the transcript, their defensive posture is incredibly robust.
Okay, walk me through it.
First, we already established that they have actively managed their balance sheet down to a conservative 2.8 times leverage ratio. They're not walking a financial tightrope, they have breathing room.
True.
Second, they have engineered a massive liquidity moat. They reported $1.6 billion in total available liquidity, which includes a massive $1.3 billion asset-backed credit facility with Wells Fargo. Crucially, that facility does not mature until 2030.
Oh, that's huge.
Yeah, they have secured a multi-year cash buffer to weather potential storms without facing a liquidity crisis.
But liquidity only solves the debt side of the equation. What about the physical assets? If demand drops off a cliff, they still physically own tens of thousands of bulldozers, cranes, and generators. In a heavy equipment business, an idle machine is a major liability.
And this is where their operational strategy reveals its brilliance. The CFO made a point to explicitly state that their average fleet age across the entire network is currently only 30 months old.
Okay, so why is a 30-month fleet age the ultimate trump card in a downside scenario?
Because of how depreciation and maintenance cycles work in heavy machinery. In the equipment rental industry, large machines typically have a useful life of 7 to 10 years before the maintenance costs like engine rebuilds, hydraulic replacements become economically prohibitive.
Gotcha.
Because Equipment Share's fleet is extraordinarily young at just 30 months, they possess the ultimate operational flexibility. If a severe recession hits tomorrow and rental demand plummets, they do not have to panic. They can execute an immediate flex on their capital expenditures.
By flexing, you mean they can instantly halt the purchase of new machines?
Exactly. They completely pause all CapEx. They stop buying new iron from the OEMs.
Yeah.
They halt the rollout of new greenfield locations.
Yeah.
And because their existing machines are so young, they won't require massive maintenance overhauls for years.
Oh, I see.
They can simply allow their existing young fleet to organically age for 2 or 3 years while continuing to rent it out at whatever the market demand supports.
I see the mental model now. By shutting off the growth engine, they instantly transform the company from a hyper-growth compounder into a massive free cash flow generating machine.
Exactly.
They just harvest the cash from the highly reliable fleet they already own, use that cash to pay down existing debt, and survive the cyclical downturn completely unscathed.
Precisely. They have engineered a built-in shock absorber. They're growing at 37% today because the mega project demand dictates it, but they have their foot hovering right over the brake pedal and their tires are brand new.
Which brings us to the culminating analysis of our deep dive today. We have explored the headline beats, the massive margins, the vertical sauce integration of T3, the physics of the data center boom, and the mechanics of their defensive posture. I need your final talk ticker's verdict.
Okay.
Based on the totality of this Q1 2026 earnings call, are you walking away bearish or bullish on EquipmentShare?
I'm taking a highly opinionated, definitively bullish stance on this company.
Bullish. Okay.
What we are witnessing is an organization perfectly exploiting a K-shaped recovery in the construction market.
We hear the term K-shaped thrown around by macroeconomists constantly. Let's ground that concept for the listener. What does a K-shaped reality look like for a heavy equipment provider?
Well, in a K-shaped dynamic, the broader industry splits into 2 starkly diverging paths. One arm of the K accelerates upward, while the other arm plummets downward.
Right.
If you look at general residential construction, single-family home building, or standard commercial office space right now, that market is the bottom arm of the K. It is stable to soft, heavily weighed down by high mortgage rates and shifting remote work trends.
Yeah, nobody is building office towers right now.
Right. If EquipmentShare was primarily renting excavators to local contractors building suburban subdivisions, I would be deeply cautious about their future.
But the data in the call proves they aren't playing in that sandbox.
They have completely insulated themselves. The transcript explicitly notes that 87% of their rental revenues are derived from industrial and non-residential end markets.
87%.
Yeah. They have firmly attached themselves to the top arm of the K. They are capturing the massive government-subsidized upside of the generational boom in energy infrastructure, data centers, and advanced manufacturing onshoring. They are surfing a secular megatrend, and they have the exact technological surfboard T3 required to win the business of the massive sophisticated clients executing those projects.
I am entirely aligned with your thesis. I am deeply bullish as well. But let's make this actionable for the listener. If you are examining this company as a mental model for your own investments or business strategies, what is the core takeaway? Let's start with current holders of the stock.
For current holders, you are looking at a classic compounder that has proven it can scale hyper-aggressively without destroying its balance sheet. But the true hidden gem for current investors, the mechanism that we haven't fully explored yet, is something they call their own-end program.
Yes, the OWN program. This is arguably the most fascinating strategic pivot in the entire transcript. They reported executing $102 million in equipment sales into the OWN program in Q1 alone.
It's brilliant.
For anyone studying capital light scaling, this is a literal masterclass. Break down the mechanics of how this program operates and why it is such a brilliant growth hack.
So the OWN program is a highly sophisticated capital light vehicle that allows EquipmentShare to fund its massive 700 location fleet expansion using other people's money.
Other people's money, always the best kind.
Always. It solves the core problem of a capital-intensive industry. Instead of EquipmentShare taking on bank debt to buy a new $200,000 excavator to meet demand, they allow outside capital, specifically high net worth individuals, family offices, and institutional yield seekers, to actually purchase the physical machine.
Wait, so the outside investor legally owns the physical asset, but what do they do with it? Like a family office in Manhattan doesn't know how to rent out a bulldozer in Texas.
And they don't have to. EquipmentShare takes that investor-owned machine, integrates it natively into their T3 platform, and deploys it across their national rental network.
No.
Yeah, EquipmentShare handles all the logistics. They find the customer, dispatch the machine, collect the rental fees, and manage all the physical maintenance and repairs. In exchange, they split the rental revenue with the outside investor.
It functions almost exactly like a franchise model, but instead of franchising a fast food restaurant, they are franchising individual pieces of heavy machinery.
That is exactly what it is.
EquipmentShare gets to rapidly expand the total fleet under their management, capturing massive market share and generating high-margin service and management revenue entirely without bloating their own balance sheet with the capital cost of the machines. And the transcript noted that demand from investors to participate in the OWN program is, quote, multiple times oversubscribed.
It is oversubscribed because it offers an incredible alternative asset class for institutional capital.
Yeah.
And again, this is only possible because of T3.
Right, the tech makes it possible.
Exactly. Before T3, a family office would never buy a random excavator because they would have zero visibility into where it was or how it was being used. It was a black box. But with T3, those investors have unprecedented real-time digital visibility into the exact GPS location, the engine utilization rate, and the financial yield of the physical assets they purchased.
They can track their investment on their phone.
Yes. It creates a transparent, high-yield infrastructure investment. For current shareholders of EquipmentShare, the OWN program is the secret financial engine. It is the lever that allows the company to chase that massive 700-store goal without crushing the corporate entity under a mountain of leverage.
It is the ultimate expression of software-like economics applied to heavy industry. And what about for prospective buyers, for the listener who doesn't hold the stock yet but is intrigued by the moat and the 37% growth we've discussed today?
For prospective buyers, the primary mental model you need to adopt is this. Look past the traditional equipment rental label. Do not value this company using the exact same multiples or assumptions that you use to value legacy competitors who simply lease dumb iron.
Right.
EquipmentShare is not competing on the daily rental rate of a bulldozer. They are pricing their services based on the immense downstream value and the operational risk reduction provided by their technology stack. Because T3 natively solves the chaotic realities of access control, predictive maintenance, and multi-tenant data sharing on multi-billion-dollar mega projects, EquipmentShare commands incredibly deep pricing power in a historically fragmented industry.
They aren't winning on price.
No, they are not winning contracts because they are the cheapest option. They are winning because they mathematically make the general contractor more efficient and more profitable. You are fundamentally evaluating a technology and logistics platform that utilizes heavy machinery as its distribution mechanism.
That is a phenomenal summary. To wrap up this deep dive, we have dissected a company that is actively rewriting the operating system of an $84 billion industry. We've explored how staggering 38% top-line growth is being fueled not by reckless corporate debt, but by a vertically integrated, undeniable technological advantage.
Absolutely.
We have seen how they are perfectly positioned to capitalize on the largest, most power-hungry infrastructure mega projects of our generation, while simultaneously utilizing the brilliant OWN program to scale with capital-light efficiency. It is a masterclass in modern industrial execution and risk management. I want to thank you, the listener, for joining us as we unpack the layers of this incredible earnings call.
But before we officially sign off, I want to leave you with one final forward-looking thought to mull over.
Oh, okay. Let's hear it.
It's something that builds directly on management's brief comments regarding the future of artificial intelligence within the T3 platform. Right now, as advanced as T3 is, it still functions primarily as an incredible digital ledger. It captures live, high-fidelity operating signals from thousands of machines and presents that data cleanly to human operators, allowing those humans to make better, faster decisions.
Which, to be fair, is already a quantum leap over a project manager running around a muddy field with a clipboard and a walkie-talkie.
It absolutely is. But what happens tomorrow?
What do you mean?
We know that T3 already holds the deterministic, structured, real-time data for thousands of machines in complex workflows. What happens to the fundamental nature of the construction industry when EquipmentShare embeds advanced reasoning AI directly into the T3 architecture?
Oh, wow.
Imagine a future job site where the heavy machinery autonomously allocates its own resources. Imagine a scenario where a massive excavator dynamically detects its own failing hydraulic pump, instantly cross-references the local warehouse inventory, and autonomously orders its own replacement part via a smart contract, scheduling the maintenance window during off hours, all without a single human being ever making a phone call or pushing a button.
You are describing a shift from a software system that reports reality to an intelligent system that autonomously orchestrates reality.
Exactly. If I can pull that off, and they already own the hardware and data layers required to do it, Could this company, currently disguised as an equipment rental business in Missouri, quietly become the AWS of physical infrastructure?
Now, that is a thought to chew on. So the next time you are stuck in traffic and you look up at a towering city skyline under construction, don't just look at the steel beams and the cranes. Think about the invisible digital network running through them. Think about the telemetry data flowing from the engines and the company that is quietly, fundamentally rewriting the rules of how the modern physical world is built.